Okay, welcome back to this wonderful chapter, Cost of Capital. Cost of Capital revision today. Very important chapter. So, those who are interested can write down, or there is a formula book. You can refer the formula book, it is written there. All the formula we will revise. We will take few questions also. Okay, are you ready?
Yes, sir.
So, first we will see the formula for cost of irredeemable debt. Cost of irredeemable debt. Cost of capital chapter, first step is to find out the cost of specific source of finance. Under that, cost of irredeemable debt. How will you know that it is an irredeemable debt in the problem? When the number of years are not given. When the number of years are not given. So, formula is KD is equal to I into 1 minus T, T means tax rate, divided by net proceed or current market price, or current market price. If net proceed is not given, then current market price, and net proceed is equal to issue price minus flotation cost. Issue price minus flotation cost. Flotation cost means issue expenses like brokerage and commission. Okay. Then we will see cost of redeemable debt. Cost of redeemable debt. So, here we have two formulae. First formula is KD is equal to I into 1 minus T plus RV minus NP divided by N, and this whole thing divided by RV plus NP by 2. What is RV? Redemption value. If redemption value is not given, then it is assumed to be at par. And what is the second formula? KD is equal to I into 1 minus T plus RV minus NP upon N, this also into 1 minus T divided by RV plus NP by 2. If difference between RV and NP can be amortized for tax purpose, then you have to use second formula. Otherwise, whichever formula you will use, write the assumption.
Yes, sir.
This formula gives you approximate answer, and for accurate answer, the third method is called yield to maturity, YTM, or IRR method. IRR means internal rate of return. If the problem is specifically ask you internal rate of return method, which they have asked in the exam, then you follow the same. The formula for IRR is lower discount rate plus NPV at lower discount rate upon NPV at lower discount rate minus NPV at higher discount rate into higher discount rate minus lower discount rate. Right? This formula can be used anytime for finding the cost of debt. Now we'll write cost of preference share capital. Cost of preference share capital, under that A, irredeemable preference share capital, number of years are not given in the problem, then in that case cost of preference share will be equal to preference dividend upon net proceed or current market price. Net proceed or current market price. Net proceed means issue price minus flotation cost.
Yes.
And B, write down redeemable preference share capital. So cost of preference share will be equal to preference dividend plus RV minus NP upon N. N means number of years, divide by RV plus NP by 2. RV means redemption value. If redemption value is not given, assume redemption is at par. And third method is called YTM or IRR method. Same formula written above for YTM or IRR. If NP and current market price both are not given, then take face value. Okay, if NP and current market price both are not given, then take face value. Okay. So up to preference share, any problem?
No, sir.
Now we'll revise cost of equity shares. Write in good handwriting. Revise one day before the exam. Cost of equity share capital. So under this we have different approaches. One is called dividend price approach or dividend discount model. Or discounted cash flow model. So if the institute uses dividend price approach, dividend discount model, discounted cash flow model, then use this. Under this also we have first situation, constant dividend. Dividend remains constant. Okay, no growth, bracket no growth, zero growth. So cost of equity will be equal to dividend upon price. Dividend upon price. Then write down in case of new issue or fresh issue of share, cost of equity will be dividend upon current price minus F, where F is flotation cost, where F is flotation cost in case of new issue. And second, write down dividend growing at a constant rate. Dividend growing at a constant rate. So this is called growth model, also called Gordon model, also called Gordon model. So, the formula here is cost of equity equal to D1 upon P0 plus G. D1 is equal to D0 into 1 plus G. If last year dividend is given, it is D0, convert into D1, convert into D1. If next year or expected dividend is given, then it is D1. Then it is D1. Then write down growth rate G is equal to B into R, where B is equal to retention ratio. If suppose in some problem growth rate is not given to you directly, so in B's retention ratio is equal to 100 minus dividend payout ratio, 100 minus dividend payout ratio, and R is called return on equity, return on equity. Dividend payout ratio is equal to DPS upon EPS. Dividend payout ratio equal to DPS upon EPS. Interested candidate can write down in good handwriting. Are you writing?
Yes, sir.
Is it over? Okay. Then write down alternative formula for growth rate. G is equal to future value upon present value to the power 1 by n minus 1. Is it right? For example, they will say in 2021 EPS was, for example, 10. Don't write now. This you don't have to write. And in 2026 EPS is, for example, 15.5. So what you will do? You will take in such question 15.5 divide by 10 to the power, you have to see how many years are there, 5 years minus 1, and then solve this equation, you will get the growth rate. Okay. So depending upon the question, growth rate can be found out by applying this formula or the formula B into R. So this was about dividend discount model. Second, write down, this was point A here. So now point B is called earning price approach. Earning price approach. So here also we will write two formula. One is constant EPS, no growth. Then the formula is cost of equity equal to EPS upon price or 1 by price earning ratio, both are same, or 1 by price earning ratio. And second formula is growth approach. So the growth approach K is equal to EPS upon price plus G. EPS upon price plus G, right? So this was earning price approach. Now the next approach is called realized yield approach. Realized yield approach, it is based on past return. It is based on past return. Okay. Then write down A. If data of 1 year is given, then return is equal to D1 plus P1 minus P0 divided by P0. So what is D1? D1 means dividend. P1 means price at the end, and P0 means price at the beginning. P1 minus P0 is capital gain or loss. So return comes in two form, one in the form of dividend, one in the form of capital gain or loss. Okay. If more than 1 year data is given, then one method is use IRR technique. If more than 1 year data is given, you can use IRR technique, or calculate return of each year. Calculate return of each year and we have to complete the sentence. Calculate return of each year and calculate average return or geometric mean. Average return or geometric mean. Average return or geometric mean. Is it right? So average return will be simple average return. Return of year 1, return of year 2, up to return of year n. Suppose 5 year is given. So first to compute individual year return by this formula, and then take the simple average by dividing by number of years. Okay. or you can compute geometric mean. Geometric mean. So geometric mean is 1 plus R1 into 1 plus R2 into 1 plus R3 dash dash into 1 plus Rn, and the whole thing to the power 1 by n minus 1. This is how we compute the geometric mean. Is it right?
Yes, sir.
So these are the formulae for realized yield approach. Now next we will see fourth approach called capital asset pricing model. Capital asset pricing model called CAPM. So here the cost of equity is RF plus beta into RM minus RF. RF means risk-free return.
Yes,
Risk-free return means return on government security. For example, treasury bond. B is beta. Beta is equal to systematic risk, and RM is equal to return on market portfolio. Return on market portfolio. RM minus RF is market risk premium. So if the problem says market risk premium, it means RF is already deducted. Do not again deduct RF. Okay. So these are the formula for computing cost of equity. Now write down cost of retained earning. Cost of retained earning, KR is equal to KE. KR is equal to KE. Except in case of retained earning, flotation cost is not involved. Flotation cost is not
yes,
involved. Flotation cost is not involved. Okay. Any query? Then write down, if personal income tax is also considered, if personal income tax is also considered, then cost of retained earning is cost of equity into 1 minus TP into 1 minus F. So what is TP here? TP here is rate of personal income tax. Very rarely asked. And what is F? F is the rate of flotation cost. So this formula is from investor's point of view. In bracket, this formula is from investor's point of view, because investor will receive dividend and he will have to pay tax on dividend. Investor will receive dividend and he will have to pay tax on dividend. Otherwise, for retained earning, the formula will be same as cost of equity. Retained earning represents opportunity cost of equity shareholder. So, cost of retained earning is taken same as cost of equity. But the benefit of retained earning is that there is no flotation cost. Is it right? So, after we will compute one more thing, write down cost of term loan. In some problem, term loan is given. So, here the cost of term loan is simply interest rate into 1 minus tax rate. I stands for interest rate and T stands for tax rate, because interest is tax deductible. After that we have weighted average cost of capital. The next heading is weighted average cost of capital, which is called WACC. Is it right? So, here what we do, we compute the weighted average cost of various sources of finance. So, WACC will be equal to cost of debt into weight of debt plus cost of preference share into weight of preference share plus cost of equity into weight of equity. Okay. And how do you usually solve? We solve by preparing a table. Either you can use the formula or you can prepare the table. How many columns we will draw? Source, amount, weight, cost, weight into cost. Highly tested in the exam. In source, whatever source they have given, equity, debenture, preference share. Write amount, take total. Amount of equity divided by total is weight of equity. Write cost, multiply. This total is called weighted average cost of capital. Is it right? There are two approaches. Which are the two approaches? One, book value weights, and second, write down market value weights. Book value weights and market value weights. So, what is book value weights? It is taken from books of account. It is taken from balance sheet. And market value weights means we will calculate the market value of different sources of finance. Is it right? So, write note here. If market value weights are used, then market value is equal to number of security into market value per unit. Yes or no?
Yes, sir.
So suppose there are 60,000 share. 60,000 into market price is 250 into 250. Okay. Now write down next note. If market value weights are used, are you writing?
Yes, sir.
If market value weights are used, do not consider retained earning or reserves and surplus in source column or reserve and surplus in source column. But if the cost of equity share capital and cost of retained earning are different, if suppose the cost of equity share capital and cost of retained earning are different, KE is different from KR, then the market value of equity is apportioned between share capital and reserves and surplus in the ratio of book value. In the ratio of book value. Do you remember something like this? You might have studied. Yes. Otherwise, you can just write equity in place of equity share capital and reserve. But if the cost of equity and cost of reserves are different, then the student will have to divide the total market value of equity share in the ratio of book value. Okay. And one more thing, write down. Marginal cost of capital, MCC. So right here, it is the cost of raising additional capital. Cost of raising additional capital. Here, weight will be actual funds raised. Weights will be actual fund raised. MCC will be equal to WACC when weight and cost of each source of finance are same. Is it right? If the cost and weight of each source of finance are same. Okay. If the problem says existing capital structure is optimum. If the question says existing capital structure is optimum, then use the weight of existing capital structure, use the weights of existing capital structure for calculation of MCC, for calculation of MCC. One more point. If you have to find the capital investment required without raising fresh equity, then value of capital investment equal to value of capital investment is equal to retained earning used for capital investment, retained earning used for capital investment divided by proportion of equity in total capital structure. Is it right? If the problem says what is the maximum value of a capital investment when we don't have to issue fresh equity, it is only funded from retained earning. So retained earning available for capital budgeting divide by proportion of retained earning in the total capital structure. So you don't have to issue fresh equity. But if your value of capital investment is more than this, then you will have to issue fresh equity. Is it right? So now we will take some questions for revision purpose. Are you ready?
Yes, sir.
So kindly come to our book. Question number 40 will solve immediately. Question number 40 is from April 22 MTP for 10 marks. The capital structure of RV Limited on 31st March 2022 as per its balance sheet is as follows. Equity share capital is 25 lakh rupees. Face value is 10 rupees. So how many numbers are there? 2,50,000. 10% preference share of 100 rupees each. 5 lakh divided by 100. Come on. 5,000 preference shares. Very good. Retained earning, let it be. Debenture of 100 rupees each. 20 lakh. So there are 20,000 numbers of debenture. Why we need this? To compute market value. Okay. The market price of equity share is 50. This is P0. Expected dividend. Expected what means next year dividend. D1 is expected to be 3. Dividend per share is expected to grow at the rate of 8%. G is 8. So how will you use this information to find cost of equity? Is it right? Preference shares are redeemable after 8 years and the current price is 80 per share. So this will be required for cost of preference share. So it is a question of redeemable preference share. In this question we will be able to revise many concepts. Debentures are redeemable after 5 years. This is 5. Currently selling at 90 per debenture. So current price of debenture and current price of preference share will be used in place of net proceed in the formula, and will also be used for calculation of weights based on market value. Is it right? Tax rate is 35%. This I will require for debenture. Compute WSCC using book value proportion and using market value proportion. What is my first task? To calculate cost of each source of finance. What is my second task? To calculate WACC. This will give you 10 marks. So do you want 10 marks? Say yes or no. Yes. Right. First write down cost of equity share capital. So which approach we will use? Dividend price approach. Using dividend price approach, because data is given for dividend price approach. Cost of equity equal to D1 by P0 plus G. So what is the cost of equity? What is D1 in our question? 3 rupees. What is P0? 50. Growth rate is how much? 8%, 0.08. So that comes to 14%. Then second question, or second, calculate cost of preference share. Redeemable preference share. The formula for this is preference dividend plus RV minus NP upon N upon RV plus NP by 2. RV means redemption value, NP means net proceed. If net proceed is not given, we can use the current market price. How much is preference dividend? Give me the answer. Preference dividend per share 10 rupees. Write down 10 rupees. What is redemption value? 100. Net proceed is not given. Current price is 80. Number of years are 8. Divide by 100 plus 80 by 2. Give me the final answer in percentage term. So can we write 13.89%?
Yes.
Approximately 13.89. And the third instrument is debenture. So write down cost of redeemable debenture. Cost of redeemable debenture. KD is equal to formula I into 1 minus T plus RV minus NP upon N upon RV plus NP by 2. How much is the interest rate? 13% of 100, 13 rupees. What is tax rate? 35%. 1 minus 0.35 plus redemption value 100, net proceed, current market price 90, number of years 5 years. 5 years. Divide by 100 plus 90 by 2. Into 100. Final answer will be in percentage. 11%. 11%. Write one note. It is assumed that difference between redemption value and net proceed is not amortized for tax purpose. Is not amortized for tax purpose. Okay. So we have not multiplied this by 1 minus t. You can solve by that also. Now any query? So we'll compute now WACC at book value also and market value also. So write calculation of weighted average cost of capital. Calculation of weighted average cost of capital. First we'll write source, then write cost, then write book value weights. Under that we'll draw 3 columns: amount, weight, weight into cost. It will save time in the exam. You want to prepare 2 separate table, you can do it. And then write market value weights. Write market value weights, 3 columns again: amount, weight, weight into cost. Cost column is common for both. Keep one line blank when you write the source. Are you ready? So we have total 4 sources. Copy in the same order from the question. Keep question in front of you. Equity shares, preference shares, one line blank, then retained earning, retained earning, retained earning, and then 13% debenture. This is how you can write nicely and get good marks. So first you tell me cost of equity share in our first step. 14%. Cost of preference share 13.89. What about cost of retained earnings? Same as equity share because there is no flotation. And debenture
It is 11%.
11%. Amount copy from the book. You can write rupees in lakhs here. Rupees in lakhs. 25, 5, 5, 20. Total. Anybody total 55 lakh? And then how to write weight in quick format? 25 by 55, 5 by 55, 5 by 55, 20 by 55. Now dear student, take your calculator, multiply cost into weight. Cost into weight and give me the answer. Do not multiply by percentage sign, just multiply 14 into 14 into 25 by 55. 6.36 is right. Come on, next.
1.26.
1.26. Come on, next.
1.27.
1.27. Come on, next.
3.9.
3 point
4.
3.40.
Exact 4.
3.4.
2.
So WACC equal to
12.9.
12.9%. Approx write down in bracket. Any query? Now what about the market value? How many equity shares are there? There are 2,50,000 equity shares are there. And what is the price per share? 50. So multiply and answer in rupees in lakhs. So is it 125? How many preference shares are there? 5,000 into price is 80 rupees in lakhs, 4 lakhs. How many? Retained earning will not write, because cost of retained earning and cost of equity share are same. So when both are same, everything is covered in the cost of equity here only. Otherwise we'll have to bifurcate, but the answer will not change. The answer will not change. So therefore we will not write retained earning when we are taking market value of equity share. The market value is for entire equity shareholders fund,
Yes, sir.
not separately for equity share and retained earning. Come on, student. Debenture. How many debentures are there? 20,000
20,000 debentures. 90 per piece.
into 90. Come on.
20.
Is it 18 lakh? Just write 18, because we are writing in lakhs. 125 plus 4 plus 18. 147.
22. 147.
Wait, write down 125 by 147. 4 by 147. 18 by 147. Now students, please answer. Multiply weight into this cost column, second column. 11.9 is right. Come on, next.
0.3.8.
0.38. 0.38. Very good. Next. Last one.
So 1.35.
1.35 total.
13.63.
13.63% approximately. This is WACC equal to
WACC equals to
around 13.63%. Is it right? Say yes. Now we'll come to question number 38. December 2021 exam for 5 marks. Question 38 in your book. Question number 38. You will find it. Have you found it? Say yes.
Yes, sir.
Book value of capital structure of B Limited is as follows. 12% 6,000 debenture of 100 rupees each.
Yes, sir.
Retained earning, equity shares of 100 rupees each. Currently the market value of debenture is rupees 110 per debenture, and market value of equity share is 180 per debenture. Expected return of equity shareholder is 24%. What is this? Expected rate of return of equity shareholder is 24% per annum. This is cost of equity. This is cost of equity. Cost of equity is the expected return of equity shareholder.
Yes.
So here the new thing they have mentioned is this line, which means the expectation of equity shareholder is the cost to the company. Company is paying tax at the rate of 30%. Why this is given? For calculating cost of debenture. Compute WACC using market value weights. Is it right? So how do we solve it? So we'll have to find cost of debt first. Is it right? After computing cost of debt, cost of equity is already given to you, or cost of equity, expected rate of return of equity shareholder is 24% per annum. So this is they have not mentioned it clearly,
Interest rate.
whether it is dividend rate or whether it is final return expected by the investor. So as per the institute answer, if we see, they have assumed it to be dividend per share. They have used it for calculating dividend per share. Okay. So write. First write down step 1. Calculation of cost of. Now tell me, is it a redeemable or irredeemable debenture?
Irredeemable.
Because the number of years are
Not given.
not given. So we'll use the formula for irredeemable debenture. KD is equal to
KD equals to I into 1 minus T.
1 minus T upon net proceed. If net proceed is not given, you can take current market price. You can take current market price. Interest rate is 12%. 12% of 100, 12 rupees.
12 rupees.
Tax rate is how much?
So it is 31. 0.3.
0.3. Net proceed is not given, but current price of debenture is 110. 110.
Yes, sir.
Can you see that?
Yes.
Question number 38. December exam for 5 marks. So how much is that?
7.64%.
So can I write 7.64%? Step 2, write down calculation of cost of equity share. Write a note. It is given that expected rate of return of equity shareholder is 24% per annum. Right?
Yes, sir.
Expected rate of return of equity shareholder is 24% per annum. It can be interpreted in 2 ways. It can be interpreted in 2 ways. One, 24% is the rate of dividend, and second interpretation is 24% is the cost of equity. ICI has assumed it to be rate of dividend.
So if we'll take the first situation, that 24% is the rate of dividend. So
Then I am solving. this we are going to solve by this assumption. ICI has assumed it to be rate of dividend. We will also assume the same. Otherwise, in the exam, if you want to solve by this, write the assumption accordingly, because the expectation of the shareholder is the cost of equity for the company. Okay. First you complete writing. In case if you have doubt, you can ask me now, you can ask me later. Okay, so now write down below that cost of equity equal to dividend upon current share price dividend will be 24% of 100 rupees, 24 rupees. Share price is 180 and then multiply by 100, you will get in percentage.
0.34%.
How much?
13.34%.
13.34 percentage. Now write down WACC, market value weights. WACC using market value weights. Write down source, amount, weight, cost, weight into cost. Source, write down debenture and equity. There are 6,000 debenture and the market price is 110. So that comes to 6,60,000. How many equity shares are there?
4,500.
4,500 into market price is 180. So 8,10,000. So can you tell me the total? 14,70,000. So the weight will be 66 divided by 147, 81 divided by 147. Retained earning will not write because we are using market value weights. How much is cost of debenture we have computed?
7.64%.
7.64%. And what is this? 13.34%. So what you do, multiply 66 on your calculator, divide by 147 into 7.64 equal to
It is equal to 3.43.
3.43. 81 divided by 147
7.35.
into 13.34. 7.35.
10.78.
So 10.78%. This is your WACC. Then write below. Any query?
No, sir.
Write below. If we assume K is equal to 24%, then WACC will be, if we assume K is equal to 24%, write 4 columns: source, weight, cost, weight into cost. Source, write down debt, equity. What will be the weight? Weight will be same. Weight will not change. 66 by 147 81 by 147. Cost of debt will take same 7.64, but cost of equity we will take now 24. This we are changing. So this is second interpretation. Multiply. This will be same what you have written here, 3.43. It can't change. 13.22. So by a different assumption, the answer will be 16.65%. 16.65%. Now we'll take one November 2020 exam, 4 marks. Just check this question is there in the last. What is the number? One more variety. Question number 47. For 4 marks, November 2022 exam. Is it right? MR Limited is having the following capital structure, which is considered to be optimum. Underline. Optimum means best. So the new funds will be raised in the same ratio. So this question is based on marginal cost of capital. As on 31st March 2022, equity share capital 50,000 share, 8 lakh, 12% preference share 50,000, 15% debenture 1,50,000, total 10 lakh. So what is the weight, can you tell me? 8 lakh divided by 10 lakh, 0.8. 50,000 divided by 10 lakh,
0.05.
0.05. 0.15. Is the total equal to 1? So these are the weights of these three sources when the capital structure is optimum. So it means if they want to raise fresh capital, they would try to keep the ratio same. A company which has identified that this is the optimum capital structure, then they will try to maintain the same. So new funds will also be raised in the same proportion. That is the purpose of using the term optimum there. The earning per share of the company were 2.50 in 2021 and the expected growth in equity dividend is 10%. So growth rate is given 10%. EPS is given for 2021 2.50. The next year dividend per share is 50% of the EPS of year 2021. So D1 is equal to 50% of 2.50. So that will come to 1.25. Current market price is 25. P0 is given 25. Then the problem says 15% new debenture. So they want to increase their capital, can be issued by the company. Company's debentures are currently selling at rupees 96. So you can use these two for finding cost of debt. The new, again new, 12% preference share can be sold at a net price of 91.50. Face value is 100. So this you can use for finding cost of preference share. We can find cost of equity, cost of debenture, cost of preference share. For debenture, you will require tax rate of 30% because interest is tax deductible expenditure. So again in this question we will learn the calculation of cost of equity, cost of debenture and cost of preference share. You are required to calculate after tax cost of new debt, preference share, equity share, assuming that new equity share comes from retained earning, means no flotation cost. No flotation cost. Then you have to compute marginal cost of capital. For marginal cost of capital, weight will be same which is used by the company right now, and cost of debt, preference and equity will come from previous working note. Okay. Then one more intelligent question for you. How much can be spent for capital investment before sale of new equity share, assuming that retained earning for next year investment is 50% of 2021. 50% of 2021 EPS. 50% of 2021 EPS. So what is the EPS of 2021? 2.50 into 50% into number of shares 50,000. This much retained earning they can use.
Okay.
And then you divide by the proportion of equity, that is 80%. So that will give you the amount that can be spent on capital expenditure without issuing fresh share. Without issuing fresh share, because you can finance it out of retained earning. Is it right? So first calculate how much retained earning is available, divide by proportion of retained earning. That will give you the value of capital investment without issuing fresh equity shares. Okay. Similar question is given in your study material of the institute also, and they've asked in the exam also. Let us solve in the notebook, right? Please write down, because such questions are getting asked in the exam. So we'll first find out cost of debt, equity and preference share. Are you ready? So write down cost of new debt. Cost of new debt KD is equal to I into 1 minus T upon P0. I into 1 minus T upon P0, because number of years are not mentioned in the problem. If number of years are not mentioned in the problem, then apply irredeemable debt formula. So interest rate is 15% on new debenture into 1 minus 0.3 divide by 96 into 100 so please solve. Around 10.9375% you are getting. 10.9375%. Yes, write down. Then you write down cost of new preference share. 10.9375. Yes, come on, next step 2. If you write step by step, you get more marks. Cost of new preference share. Right, cost of new preference share KP is equal to PD upon P0. PD upon P0. Preference dividend on the new preference share would be 12 rupees and its price is 91.50.
Yes.
So divide by 91.50, multiply by 100, you will get 13.1148%. Is right, 13.1148%. 13.1148%. Step 3, write down. Step 3, write down cost of new equity share. So under that, first we'll write down the basic data. Growth rate in dividend is given G. Growth rate in dividend is given, bracket G, is 10%. Next year dividend D1 is equal to 50% of year 2021 EPS. 50% of year 2021 EPS. 50% of 2.50. 50% of 2.50. 1.25. Then write down, therefore K is equal to D1 upon P0 plus G. D1 upon P0 plus G. 1.25 divided by 25 plus 0.10. Solve. How much do you get? 15%. Write down properly 15%. Presentation in detail is important to get full marks. Now write down step 4, which is our next question. Compute marginal cost of capital. Write down marginal cost of capital. MCC. Don't write W, just write MCC. In bracket write down, assuming company maintain same weight as that of existing capital structure, So first you write down the columns: source, weight, specific cost, weight into cost. Source, write equity share, one line blank, 12% preference share, one line blank, 15% debenture. Weight, how do you compute weight? Go to the question. You will see equity share is 8 lakh and total is 10 lakh. So we will assume the weight of new capital is going to be the same. So 0.8. So this is a question on marginal cost of capital. Next one, 50,000 divided by 10 lakh. 0.05. 1,50,000 divided by 10 lakh. 0.15. Specific cost we have computed. Equity is 15%. Preference is 13.1148%. And debenture is 10.9375%. You can round off in 2 digits if you want. No problem with that. Now your task is to multiply and take the total. Let us see who will do it first. Come on. First one, 12. Very good. Next. 0.65 or 66 is welcome. Third one. Come on. Third one. 1.64. Total. Make it 14.3%. So MCC equal to 14.3%. MCC equal to 14.3% bracket approx. And now we have to find out that what can be the maximum value of capital investment project we can undertake, but we don't have to issue fresh equity shares. So for that purpose we will see that how much retained earning can be used next year, and the proportion of retained earning in the total capital structure is 80%. So we'll divide by 80% because the company will always use the three sources of finance in the same proportion because it is optimum. Okay, write down the heading. Step number 5. If step number 5, write down calculation of amount that can be spent. Calculation of amount that can be spent for capital investment. That can be spent for capital investment before sale of new equity shares. Before sale of new equity shares. So first we write down EPS of year 2021. EPS of year 2021 is 2.50. Number of equity shares 50,000. Number of equity shares 50,000. Point C, total earning A into B. Write in detail. Total earning A into B 1,25,000. So they are saying 50% of that will be retained. So retained earning is 50% of 1,25,000. 50% of 1,25,000 is how much? Yes, come on, everyone. 62,500. Now many students make a mistake. They write this as an answer. This is not the final answer because company will use other sources of finance also. They want to maintain a proportion of equity, preference and debenture. So it will be only 80% of the total fund. So write down proportion of retained earning in total capital employed. Proportion of retained earning in total capital employed. This is 80% as computed above. Okay, this is computed in step 4 as per step 4. As per step 4, proportion of retained earning in total capital employed. So what we will get now is the answer of this question. Capital investment without issuing new equity shares. Capital investment without issuing new equity shares. So what will you do? D divided by E. Come on. So on your calculator. D by E. 78,125. So 78,125 is the answer.
So to use the equity shares 50%, that is of 80% of that value which is going to be.
Yes. It is 80% of the total value of this project. So if you do reverse working, 80% of this is the amount. You're going to use 80% of equity shareholder fund in financing the capital investment. Remaining amount will be from preference share and debenture. 5% of it will come from debenture and 15% will come from preference share. Is it right? Now we'll come to question number 22. Write down important question number 22. One more practice on marginal cost of capital and weighted average cost of capital. Okay. So important. Please come to question number 22. In our book, have you reached question number 22? Say yes. Masco Limited wishes to raise additional finance of rupees 10 lakh for meeting its investment plans. So how much funds are required? Rupees 10 lakh. In the previous question, they had said capital investment program. Now they've given the amount of that capital investment program. How much is that? That is 10 lakh. Total is 10 lakh. It has 2,10,000 in the form of retained earning available for investment purpose. So out of 10 lakh, 2,10,000 will be funded from own funds, retained earning. So that is 2,10,000. So remaining amount they have to raise from the market. And what is the policy of this company? That debt equity mix should be in the ratio of 3:7.
Oh,
So for every project they will undertake, they will use debt and equity. So for this company, 3:7 is the strategy or the policy. So debt should be 3 lakh and equity should be 7 lakh.
3 lakh.
3 lakh debt, 7 lakh equity. And out of equity also, retained earning will be 2,10,000. Retained earning will be 2,10,000 as given in the first paragraph. What about the balance 4,90,000? Balance 4,90,000 will be fresh issue of equity share. So they will have to issue equity share in the market for raising 4,90,000 rupees. What about debt? Total debt they will be 3 lakh, but the cost of debt is changing. First up to 1,80,000, it will be 10% before tax. And then after that, if you raise beyond 80 lakh, it will be 16% before tax. So debt again will have to raise 1,80,000 first and then 1,20,000. This 1,80,000, the interest rate is 10%. But when you keep on adding more and more debt, the cost of debt will rise and it will become 16%. Oh my God. Is it right? Earning per share is rupees 4. Dividend payout is 50% of earning, that is 2 rupees. Dividend is 2 rupees. Expected growth rate of dividend is 10%. Current share price is 44. So what is the purpose of giving this data? The purpose of giving this data is to find cost of equity and cost of retained earning. Dividend payout means dividend divided by earning per share. 50% of earning means 4 into 50% is 2 rupees. 2 rupees is dividend. Tax rate is 50%. Why tax rate is given? For finding the post-tax cost of debt. For finding the post-tax cost of debt. Now they are saying you are required to determine the pattern for raising the additional finance. Pattern for raising additional finance means how much will come from debt and how much will come from equity. So that is 3 lakh and 7 lakh. Determine the post-tax average cost of additional debt. This 3 lakh rupees that we are going to raise, what will be my average cost of debt after tax? Determine the cost of retained earning and cost of equity. So by using the formula D1 by P0 plus G, you can find out the cost of retained earning and cost of equity. Both will be same because there is no flotation cost. Am I right?
Yes.
And compute the overall weighted average after tax cost of additional finance, which means MCC. Because they are raising additional finance. Is it easy or difficult? Easy, easy, very, very easy. Okay. Okay, so write down. First answer, write down step 1, which is our first answer. Such questions have been asked in past exams. Pattern for raising additional finance. Right in the center. Pattern for raising additional finance. Pattern for raising additional finance. Then you draw two branches. Which two branches? Debt and equity. Debt will be 3 by 10 of 10 lakh, 3 lakh. Is it right? And equity will be 7 by 10 into 10 lakh, that is 7 lakh. Again, debt will have to raise as follows. First, rupees 1,80,000 at the rate of 10% in bracket before tax, and then next rupees 1,20,000 at the rate of, right, 16% before tax. This gives you a very clear picture of what is happening. Up to this you have noted?
Yes.
And what about equity? Again, first we'll write
10,000 retained.
Retained earning will be the first priority, which is given rupees 2,10,000, and then write down fresh issue of equity shares 7 lakh minus 2,10,000 is 4,90,000. This is your first answer. Any problem? What is your second question? Second, post-tax average cost of additional debt. So you are raising funds from debt 3 lakh, but they are coming at different cost. 1,80,000 you are getting at 10%. 1,20,000 you are getting at 16%. But average is not 16 plus 10 by 2. Amounts are different. Plus the impact of taxation will also be there. Is it right? So write down properly, nicely. Step 2. Step 2, write down post-tax average cost of. Every time you should write a heading nicely. Post-tax average cost of additional debt. Now under that, right hand side rupees, will prepare a table. Any way you get it, answer must be same. Format is not material. Substance is important, and it should be in an understandable format. Okay. Because this is a mathematical subject, everybody can present the answer in a different manner, but it should be understandable and it should give you correct answer. So first you write down point A, interest. How much interest we will pay? We'll pay first, interest will pay on 1,80,000 into 10%, correct? How much is that? 18,000. Then what about remaining interest on 1,20,000? 16%. Very good. So total interest here we are going to pay 37,200. But there is a benefit of paying interest. What is the benefit? Tax shield. So write down less tax shield. And look at the question and tell me the tax shield. 50%? Oh my God, 50%. 18,600 rupees you are going to save. So what is the interest net of tax? So you are effectively paying 18,600 only. You are effectively paying 18,600 only. Net outflow would be 18,600. You will pay 37,200 and you will save 18,600. So my net outflow will be 18,600. But to pay that amount, how much funds did you raise? How much funds did you raise? So debt amount. How much is debt amount? 3 lakh. So in short, you are paying 18,600 for raising 3 lakh rupees. Point number E, therefore, post tax average cost of debt. Any query?
No, sir.
You will say C divided by D into 100.
6.2%.
Anybody vouching for 6.2%? 6.2%. Anybody certifying to 6.2%? What is your third question? Cost of retained earning and cost of equity. So write down step 3. Cost of equity. First we'll write one assumption. Question as a mistake. Oh, where is the mistake? Guess. Guess where is the mistake? The mistake is that they have not mentioned whether this earning per share is current year earning per share or next year earning per share. Is it right? So we will assume it is current year EPS. We'll assume it is current year. So for next year, we have to increase it by the growth rate 10%. Okay. So write assumption. It is assumed that EPS given in the question is current year EPS. Current year EPS. Then write down dividend per share equal to EPS into dividend payout ratio. EPS into dividend payout ratio. How much is EPS for? Dividend payout ratio 50% of earning. So this is rupees 2. In bracket D0. So D1 will be D0 into 1 plus G. Is it right? 2 into 1 plus 0.10 is 2.20. P0 is 44. Growth rate is 10%. So cost of equity will be D1 by P0 plus G. $2.20 divided by 44 plus 0.10 is equal to final answer. Final answer is 15%. This is cost of equity. Any query? Cost of equity is 15%. Presentation should be such that institute should understand. And then we write down step 4, cost of retained earning. Cost of retained earning. Cost of retained earnings KR is equal to KE is equal to same 15%. Is the answer 15% right? So cost of retained earning will also be 15%. So it completes my third question, cost of retained earning and cost of equity. And the last answer, write down step 5. Overall weighted average after tax cost of additional finance. Overall weighted average after tax cost of additional finance. Source right, weight, cost, weight into cost. Amount is not required. Why amount is not required? Already weight is given in the problem, 3:7. Debt equity. Weight is given in the question. So 3/10, 7/10. Don't write 3/7. 3 is debt, 7 is equity. So 3 plus 7 is 10. And what is the cost of debt? Average cost we have computed 6.2%. And cost of equity, which will include both retained earning also, 15%. Now you tell me the answer. 6.2 into 3/10. 1.86. Sorry, 1.86. Okay, next.
12.36. मतलब 10.5%.
10.5.
Total is 12.36.
12.36%. So WACC equal to 12.36%. Is it right? Come to question number 25. Read yourself. Read question 25 yourself. After reading, what do you observe? Almost same as 22, except the debt equity ratio. All remaining details are same. So kindly do it as homework. It was May 2018 RTP. Okay, so tick mark 25 as homework. Follow the format I have already used. Now we'll take question 34 from May 19 exam. Question number 34 from May 19 exam. All questions that I am doing are important. Alpha Limited has furnished the following information. EPS 4, dividend payout ratio 25%, market price 50, rate of tax 30%, growth rate 10%. Company wants to raise an additional capital of rupees 10 lakh, including debt of rupees 4 lakh. Cost of debt before tax is 10% up to 2 lakh and 15% beyond that. Compute the after tax cost of equity and debt and also calculate the weighted average cost of capital. Is it right? If you look at the question, it is similar to the previous problem. But what is the difference? Retained earning is not mentioned separately. So how much is the total funds to be raised? 10 lakh. How much is debt? 4 lakh. So what will be equity? 6 lakh. Equity will be 6 lakh. So, first we will find out the cost of debt, then we will find out the cost of equity, then we will find out the weighted average cost of capital. Is it right? Say yes. Right. This is an exam question for 5 marks, May 19 exam. Can be repeated for your exam also. Are you enjoying or not?
Yes, sir.
Calculation of post-tax cost of debt. They have just simplified the previous problem. Okay. So, this is another format in which this question can be asked. Write down first interest. Point number A, interest. Under that, on rupees 2 lakh, they are going to raise first 2 lakh at what rate? 10%.
2 lakh, 10%.
So, they will have to pay 20,000. On next rupees 2 lakh
15%.
at the rate 15%. So, that will be 30,000. So, total interest 50,000. Point B, less tax shield at the rate of, what is the tax rate? 30%. So, 30% you will save in the form of tax, 15,000. So, what is interest net of tax? So, what you actually pay from your pocket is 35,000. And what is the amount of debt? 4 lakh. In order to raise 4 lakh, you are paying 35,000 rupees net of tax. So, therefore, post tax cost of debt. Apply common sense. You are paying 35,000 for 4 lakh rupees. C by D into 100. Student will answer 8.75%. Is it right? Step 2, write cost of equity. Cost of equity, KE. Note, it is assumed that EPS given in the question is current year EPS. They are not mentioning in the problem. Student can get different answer. So, now write down DPS is equal to EPS into dividend payout ratio. EPS is 4, DP ratio 25%. So, that is D0, you can say D0 equal to 1. D1 will be D0 into 1 plus G. What is the growth rate in the problem? 10%. So, that D1 will be equal to how much? 1.1. So, cost of equity will be D1 by P0 plus G. D1 by P0 plus G. 1.1. P0 is how much? 50 rupees. Growth rate is how much? 0.10, 12 point, 1 second, 12.2% is right. Now one student wants to ask a query, come on.
So that D naught is 1, that is 25% of 4. We are assuming that because we have given the growth rate, right? If growth rate is not given, we can assume it as
If growth rate is not given, then it will not affect your answer, because then dividend will remain constant only. Oh my god. So you have to write the assumption. So now the last step is WACC. Up to this, any other doubt?
no, sir.
Done. Step 3, WACC. Actually it is MCC, but they have used the term WACC in the problem. Source, amount, weight, specific cost, weight into cost. Source, write down debt equity. Debt equity. Debt is 4 lakh. Total amount they want to raise 10 lakh. So what is equity? 6 lakh. Understandable. Weight will be 0.4 and 0.6. 4 lakh by 10 lakh. 6 lakh by 10 lakh. What was the specific cost of debt? Is it 8.75%? 8.75%. And equity was 12.2%. 12.2%. 0.4 into 8.75.
3.5,
0.6 into 12.2.
7.32,
10.82%. Is it right? Come to one question number 26. One more variety. Question number 26. November 18 RTB. You will prepare a lot of things, but institute will always give you surprise. Variety of question have to be practiced. Okay. There is no shortcut. Messrs. Navya Corporation has a capital structure of 40% debt and 60% equity. The company is presently considering several investment proposals costing less than rupees 20 lakh. So they are considering different projects. That means these are the project cost. The corporation always raises the required funds without disturbing its present debt equity ratio. Underline. It means whenever they will raise funds,
they will maintain this.
they will maintain this ratio. Some company follow this policy of using a certain percentage of debt and a certain percentage of equity. This company follows 40-60 ratio. Cost of raising debt and equity are as follows. If you raise up to rupees 2 lakh, cost of debt will be 10, equity will be 12%, but for 2 lakh to 5 lakh, 11% cost of debt, 13% cost of equity. For between 5 to 10 lakh, cost of debt is 12%, cost of equity is 14%, and 10 to 20 lakh, 13 and 14.5%. So depending upon what is the project cost, Accordingly, its weighted average cost of capital will vary. Is it right? Assuming tax rate is 50%. Why this is given?
To calculate on the
To calculate the cost of post-tax cost of debt. Question has a mistake. They have not mentioned very clearly whether it is pre-tax cost of debt or post-tax cost of debt. So what assumption we will write? Assumption right. Assumption dash. It begin with assumption. It is assumed that cost of debt given in the question is pre-tax cost of debt. Cost of tax given in the question is pre-tax cost of debt. Then write below post-tax cost of debt is equal to I into 1 minus T. Okay. Now read question further. Calculate. First question is cost of capital of two project X and Y whose funds requirements are 6.5 lakh. So 6.5 lakh means it will fall in the third slab. So it belongs to this category of project between 5 to 10 lakh. Is it right? So you have to find out the weighted average cost of capital if the funds raised are between 5 to 10 lakh. And second is 14 lakh. 14 lakh means it will fall in the fourth block, 14 lakh, 10 to 20. Second question is, if the project is expected to give after tax return of 10%. So reverse question now. Suppose you invest in a project and that project will give you an after tax return of 10%. The project will give you an after tax return of 10%. Determine under what conditions it would be acceptable. So when will you accept a project which is expected to give a return of 10%? When will you accept a project which is expected to give a return of 10%? So suppose you are a businessman. If a project is expected to give a return of 10%, when will you accept it? When will you accept a project which gives you a return of 10%? When will you accept a project which is expected to give an after tax return of 10% based on this question? Not general answer. So your answer will be, if the cost of capital is less than 10%, then we will accept that project, because you should accept a project only when the return is more than cost of capital. Is it right? So weighted average cost of capital of that project should be below 10%, then it will be acceptable. No calculation required. General knowledge question, even a street vendor can answer. Is it right? So first what I'll do, first I will calculate cost of project for different level of financing for different slabs. Okay. Have you written that note on assumption?
Yes, sir.
Okay, start. So first write down step 1. Step 1, calculation of WACC for different sizes of projects. calculation of WACC for different sizes of projects. Yes, now student wants to ask a query in the classroom.
If a businessman wants to earn 10 rupees.
If a businessman is not one to one, he is getting a return of 10%.
Okay, he's getting the return of
He is expected to earn a return of 10%.
He's getting 10 rupees on 100.
10 rupees on 100 rupees investment. Wonderful.
So to raise that investment, he should apply 8 or below 10.
The cost should be less than 10. Suppose this bank gives you dividend interest of 10 rupees. I am willing to lend you money. So you can borrow from me and invest in that bank. But if the bank is giving you 10 rupees interest, so you will borrow from me and invest only when I will give you funds below 10% interest rate. So that is my cost of capital when you raise funds from investor. So write down a table. This time the table format is different. Project cost. First column is copied from question. Then you write down weight of debt. WD means weight of debt. And KD means cost of debt. Weight of equity. Cost of equity. And WACC is equal to weight of debt into cost of debt plus weight of equity into cost of equity. So instead of solving by making 4 tables, we will solve in one table all 4 answers. It's like asking you 4 questions, okay? It is like solving 4 questions in one table. So first you draw this format. Project cost, weight of debt, weight of equity, cost of equity, and WACC equal to WD into KD plus WE into KE. Are you happy? Okay, so write. Just copy this from the question book up to rupees 2 lakh. Same line copy. Up to rupees 2 lakh. Weight of debt. How much is weight of debt? Every time they raise funds, they maintain the ratio of debt and equity. Debt 40, equity 60. Is it right? So this will always be 0.4 and weight of equity will always be 0.6. Stop. What will be cost of debt? It is 10 into 1 minus 0.5. Tax rate is 50%. So 5%. After tax cost of debt will be interest rate into 1 minus tax rate. Okay. Formula already written. Cost of equity is 12%. Cost of equity we don't multiply by 1 minus t. I hope you know that. Okay. So now how will you get the answer? You have to tell me. I will help you with 1.4 into 5 and plus 0.6 into 12. So 0.4 into 5 is how much? 2. And 0.6 into 12 is 7.2. So give me the answer. Is it 9.2%? 9.2%. Okay, one line blank. Now write down above rupees 2 lakhs and up to rupees 5 lakhs. So this will always be 0.4 and this will always be 0.6. Now 11% is the cost of debt in the problem pre-tax. So post-tax will be 5.5. Cost of equity will remain 13. Post-tax will become half because tax rate is 50%. So please reply now. 0.4 into 5.5 plus 0.6 into 13. So total is 10. Total is 10%. Okay, one line blank. One line blank. Write above rupees 5 lakhs and up to rupees 10 lakh and up to rupees 10 lakhs. So this will be 0.4, this will be this is a new type of question, but it was asked in your RTP. I can't take it lightly. Okay, if it is asked in the exam, then most of you will be clean bold. Cost of equity is 14%. Yes, come on, try. Give me the correct answer. 0.4 into 6 and plus 0.6 into 14. 10.8%. Very good, wonderful.
Yes.
Then write one line blank. First keep one line blank. Above rupees 10 lakh. Keep one line blank. Above rupees 10 lakh and up to rupees 20 lakh. Write properly. If you want full, write full. If you want half, write half. If you don't want anything, don't write. Is it right? So what is the cost of equity last? 14.5%. Anybody wants to answer? What is the final answer?
11.3.
11.3%. Wonderful. Now wait, our answer is not over. This will help you to answer the question number 1. Question number 1 was calculate the cost of capital of two projects X and Y whose funds requirement are 6.5 lakh. So 6.5 lakh means it will fall in this third category of projects. So what is the cost of capital of project X? 10.8. 14 lakh means it will fall in the fourth category of projects whose requirement of fund is between 10 to 20 lakh. So what is the cost of capital of project Y? 11.3%. So you have to write a note. Step 2. Cost of capital of project X and project Y. So first column write down project, second column funds requirement, funds required, and third column cost of capital. So project name is X, funds required is 6.5 lakhs rupees. So it will be third category of project. So that is 10.8%. Project Y, funds required rupees 14 lakhs. In your exam, they can change the amount. Okay, so don't remember answer. Understand. 14 lakh means it is between 10 to 20. And then you will go to the last column and check what is the cost. 11.3%. So this is your first answer. Any query on this? Now the last question is, if the project is expected to give after tax return of 10%, determine under what conditions it would be acceptable. So write down step 3. If the project is expected to give after tax return of 10%, it would be acceptable if the cost of capital is less than 10%. If the cost of capital is less than 10%, that is, in the given example, now I am going to previous page. Now you see on the screen, if the cost of the project is up to 2 lakh, it is 9.2 acceptable. 2 to 5 lakh, it is 10%. Even that is acceptable. Okay. But if the cost of project is more than 5 lakh, then it exceeds 10% and it is not acceptable. So first and second category of projects are acceptable. if the expected return is 10%. So write down this line completely. That is, in our example, if the project cost is less than or equal to rupees 5 lakhs. Project cost is less than or equal to rupees 5 lakh. 5 lakh in our example. You don't have to by heart 5 lakh. In your exam, they will change the figures. So up to 5 lakh, my cost of capital is less than or equal to 10%. So project cost up to 5 lakh will be acceptable if the after tax return is 10%. Okay. So this answer is over. Now come to question 26. Read yourself. So 26 we have just now done. So you have solved different varieties of problem. Then there is a theory question number 30, which says that discuss the dividend price approach to estimate the cost of equity capital. So a theory question was asked for 5 marks in MTP. Dividend price approach already printed in our notes, and today I had given you formula also. If the dividend is expected to remain constant, then it is dividend upon price. If dividend is expected to grow, D1 upon P0 plus G. So this approach assumes that price of the share is the present value of future dividend. Is it right? You understood now? So this wonderful chapter is over. If some questions are remaining, then you will try. Okay, you will try all the questions. You will practice all the questions in our book. Questions have been taken from your study material, RTP, MTP and exam. So thank you for this chapter.